Good morning. Thank you very much for joining us today. I'm Stephanie Weston, an analyst in the University of Rochester Investment Office. We have over 160 people registered to attend today, including board members, students, faculty, staff, parents, alumni, donors, and friends. If you would like to ask a question, please submit it through the Q&A function that is located at the bottom of your Zoom window. Doug Phillips will answer as many questions as possible at the end of his presentation. If we can't get to your question, I will contact you after the session with a response. This session is being recorded and will be posted next week on the Investment Office website. I would now like to welcome our next speaker, Ed Hajim, who will introduce Doug. Ed Hajim is a seasoned Wall Street executive with more than 50 years of experience. His recent book, On the Road Less Traveled, is a must-read, in which he describes the importance of the university in shaping his life and his wonderful experience on our board. Ed graduated from the U of R in 1958 and has served on the university's board of trustees for over 30 years. As chairman of the board's investment committee, he was instrumental in strengthening the university's endowment and has been especially involved in strategic planning and advancement efforts, including leading our highly successful $1.37 billion fundraising campaign. He was appointed board chairman in 2008 and concluded his chairmanship in 2016. In 2008, Ed committed $30 million to the university to establish the Hajim School of Engineering and Applied Sciences. The Edmund A. Hajim Science and Engineering Quadrangle is named in his honor. Thank you again for joining us, Ed. Now I'll turn it over to you.
Thank you, Stephanie. I must admit that that was a wonderful introduction, and you left out one of the most important things. And I want to start off with this pleasure of mine to introduce Doug Phillips, University of Rochester Senior Vice President and Chief Investment Officer. You left out one of the most important things I ever did during my tenure, which was to hire Doug Phillips. I spent 15 years as the chairman of the investment committee. The first 12, we ran the endowment with the committee and Dick Green, who was the CFO. He was part-time. And cleverly in 2000, we said, we really need a professional. We went out and basically did a national search and had 5 or 6 very good candidates. And what I take credit for is when we had them all lined up, I said, there's only one that stands head above all the others, and it was Doug. Luckily, we hired him before he ran off someplace else. Doug then was managing the Williams College endowment. He did an absolutely fabulous job. He basically was on the forefront of most of the things that were happening in the endowment world. And he came across extremely well, and I'm glad we hired him. Doug now works with the board's investment committee and 9 members of the investment office to oversee our endowment, which is now $3.3 billion, and a $1 billion operating capital, plus $300 million of defined benefit plans. He's also a member of the university's retirement committee, which oversees $6 billion of defined contribution plan for over 40,000 participants. He was previously, I say, the treasurer of Williams College. Before that, he actually worked with another small institution called Princeton for about 7 years in their investment administration activities. Doug also founded and chaired the investment committee for the $3 billion medical center insurance company. He also he vice chairs the International Rotary Investment Committee for many years, and he is part of a large number of investment committees, which include the Farish Foundation, Strong Museum, Gateway Music Festival, and the Rochester Philharmonic Orchestra. Obviously, he's in great demand for investment committees, given his, I guess now 30 plus years of experience. He holds a BA from Rutgers University in 1980, and an MBA from Rensselaer Polytechnic Institute in 1991. In 2010, he received the Nakubo Rodney Adams Award for Outstanding Management of Endowments. In 2020, he received the Rochester Business Journal Icon Award for his long-standing commitment to Rochester community and significant professional accomplishments. None of that is as important as his true characteristics. He is very special in that he is a superb asset allocator, with a very strong long-term view, which is an absolute necessity for an endowment CEO. And I would say he ranks among those in the pantheon of the best CIOs in the business with that fellow at Yale called Svensson and the fellow at Princeton. He's also an outstanding judge of managers and their capability. With his 30 years of experience, he's been an unusual selector of outstanding managers. He's also an excellent team builder and a manager, and he's built an outstanding team that helps him run the endowment. He manages them extremely well, and it's really a very interesting and very important group of people who basically drive our endowment. Most important in Doug's life is endowment management is his passion. And that's what he really wants to do. And he does it so well. Thank you, Doug, for all you've done for the university over the last 20 plus years. And I really believe one of the most important things I ever did was to help hire you. Doug?
And I can't thank you enough for that really wonderful introduction. And let me just say what you reflect about the University of Rochester is one of the reasons I like to work here is we just have wonderful people on the board and our faculty and physicians. And so it's really a pleasure to be able to help the school. And the other part of this, the reason we do this meeting, we've been doing it for 2 decades now, is all of us believe strongly in the stakeholder and stewardship model, that the endowment doesn't exist as a monolithic entity. It has many, many dimensions to it. And I remind people that there's 2,600, over 2,600 individual endowment accounts supporting the university. Those are pooled for investment purposes. But behind all of those accounts are people, people that have donated the money, people that receive the benefit, either students or faculty or physicians and programs. So we have to keep all this communication going, and we don't want to surprise people with unusual performance or that sort of thing. So, and I think that's really one of the great benefits, and we've all really worked well together over the years. So again, thank you for everything you've done for the university and for this office. There are some things we want to cover. Again, as Stephanie noted, your questions are best submitted through the Q&A function rather than the chat function. So if you do have a question, please be sure to send it to Stephanie using the Q&A, not the chat. And I have a few slides I want to walk through here. Stephanie, if you could put up the first slide, I appreciate it. Nice IV photo there of the Rushrees Library. Let's go on to the next one. Ed will remember that there are 3 goals that we've established back when I was hired. Those are to beat a public stock bond benchmark over 5 and 10 year periods. We've done that almost every period. And then look at our close peers and make sure that we're doing well in that group. Upper half, not always the best, but certainly the upper half. And then we need to spend money and be sure that we have enough cash coming out of the endowment to do that, and also to cover the inflation that comes into our budget. So we've met those for the 20 years I've been here. And Stephanie, let's just show a little more about that. Go to the next slide. We don't disclose the names of our close peers. This was the metric number 2 that we showed you. There are 9 of them, plus the University of Rochester makes 10. I can tell you who they are, but I'm not going to tell you which color they are. But it's Washington University, Emory University, Carnegie Mellon, Brandeis University, Johns Hopkins, University of Chicago, Cornell, Case Western, and NYU. And what happens here is that the color assignments are consistent for these periods. So, for example, the green was a school we know well, performed above us in 2020, and you can see their 3-year number, their 5-year number, and their 10-year number. We know pretty much what's going on at each one of these schools. The schools that do better than us in any given year typically take unique approaches. They may concentrate the portfolio, they may move it around more quickly, more opportunistically. We take more of a middle of the road approach here of hiring good managers, assuring that our allocations are appropriate, and then targeting the risk that matches up with the university's risk tolerance. We're a unique institution because of our high clinical care activities. We have quite a few hospitals, and the medical center has more than half of our endowment. So we do look for more stable returns, and we tend not to push push the portfolio in directions over short periods that may or may not result in better performance. We also don't lever the portfolio, and we know that certain peers do have leverage as they make allocations. They may enhance those through doubling up by borrowing. We've never done that in our program. And we also think about 10-year results as the most important. And Stephanie, if you could advance to the next slide. That's the same peer group with 10-year results shown going back to when I started. So 2001 was when I started. So there's our 10-year rolling results. And we've always placed in the upper half of the peer group. And we expect that the current fiscal year, 2021, which ends June 30th, will be a year when we place very well in the peer group. And it should drive our 10-year results up to the upper part again. But there's no guarantee we'll always be there. But many things we've done in the past 4 or 5 years have come to fruition this year in terms of performance. Let's go to the next slide. This is a chart that looks at our results in each asset category compared to the $1 billion plus peer group, which is a larger peer group. There's some larger endowments that are not in our close peer group, and there's some smaller endowments that are in the $1 billion to $3 billion range. This is available in the survey of each endowment annually. And what this does is it looks at our asset allocation decisions and then our manager performance, and it links them together to determine which parts impacted the portfolio positively and which parts negatively impacted performance. So in the last fiscal year, we had positive results in 4 categories, and we had negative results in 3 and 1 in the neutral category. We've shown this for almost every year for the past 20 years. We've never had a year when everything was positive. It's very unlikely that that would happen. We have some areas that we've had challenges, frankly, with managers. You can see that in our real assets and natural resources category. We underperformed the peer group, and we had an allocation equal to the peers on natural resources at 5% and below the peers on real estate. The reason that we underperformed, though, is worth addressing here. We are winding down those programs. We're not making new allocations. In fact, in natural resources, we haven't made an allocation since 2015. So our year, that's called vintage year, our investment periods are older, and many of the positions that are left are not performing well, as well as some of the newer positions that we could have obtained if we continued to invest in those areas. So that explains the underperformance. You'll see that allocation continues to decline over the next few years, but it was not a large enough position that it overcame the better performance from our U.S. equity portfolio, our fixed income, hedge funds, private equity, and especially our venture capital program. I want to note quickly here the non-U.S. program, the underperformance there is we'd like to perform better, but our allocations were deliberately weighted toward emerging markets, and the emerging markets exposure excluded China because we have Chinese exposure elsewhere in the portfolio. We didn't want to overweight or double weight China. So China was a big component of international performance last year. So that's explainable. Stephanie, you want to go on to the next? This chart just breaks it out a little farther. It shows the emerging markets allocation, and it shows a little more about the investment office expense, which is about, including our consulting and custody, is about 0.2%. So it's just a little further view of our allocations and performance. Let's go on to the next slide. Asset allocation. We look very much like most of the large endowments. About a third of the money is in public equities. That's broken up about a third into domestic or global equities, a third into developed international economies, and a third into emerging markets. We have about a quarter to 30%, 25 to 30% in private equity. A big part of that's venture capital. That's a global program. Our real asset program, as you saw, is about 8%. It's natural resources and real estate. Our hedge funds are a very significant weight for us. Our hedge fund program, there was a question in advance that I'll just cover here. Our hedge fund program is designed to exceed the benchmark of the portfolio with very low volatility and very low correlation to other things in the portfolio. These are not headline hedge funds that you read about that are blowing up or causing disruptions in the markets or big losses to their investors. These are typically funds that are owned by the partners. We're very closely aligned with the interests of those partners, and these are longstanding, highly diversified hedge funds. And none of them are the same. They all operate in different ways. We have a small bond allocation and cash, so that's mostly for liquidity and for rebalancing purposes. Where that bond allocation is about as low as it's been since I arrived 20 years ago. Stephanie, next one. The developing market exposure here, emerging markets, is an important part of the portfolio. We continue to see more attractive opportunities in these economies. Companies are growing faster, they're more profitable, and they're addressing enormous populations. We also have had a view about the US dollar, that the US dollar would weaken against a basket of currencies, many of which are in the emerging economies. We get to a conclusion about what to put in emerging markets by looking at our benchmark, which is the All Country World Index. It's a global benchmark of stocks. And then we re-weight that benchmark using the gross domestic products. The benchmark is typically consisting of the market caps of the stocks in the benchmark. But there are not enough stocks in these emerging economies to get an adequate weight on that benchmark. So we take those companies and re-weight them based on the GDP. And there's an enormous GDP outside the US, mostly China, but many other Asian countries and other countries. So we keep our emerging markets exposure somewhere between the capital weighted benchmark and the GDP weighted benchmark. And that's what this shows. That's the yellow line there that shows 26% in emerging, and our benchmark is 13, and the GDP weighted benchmark is 37. So we keep it in between those two benchmarks. Stephanie, next slide. One characteristic of the portfolio that's been evident since I started is that when we have these poor markets, and stock markets do go down, sometimes for long periods, and we don't want our portfolio to have as much loss as the stock market. That's not good for the budget. It can also put us at risk with donors. So this capital preserving aspect of the portfolio, not risk avoidance, but just holding on to more money when we have bad markets. It's a very important characteristic. And we don't always perform as well in rising markets. This most recent rising market we have, as you see on the right side, but typically over longer bull market periods, we lag a little bit, but we more than make up for it in these periods of bad performance by the benchmark. Next slide. This is a little slide. The yellow boxes are the most important. It shows our return and our volatility. If you look at the 10-year volatility in the yellow box on the right side, the volatility of our return is about 5.8% per year. If you look just below that, our benchmark return is 11.2% per year. So the benchmark is twice as volatile, roughly, as our portfolio. And our return over 10 years exceeded the benchmark, not by a lot, but by enough that the risk-adjusted return for us is very attractive. It's interesting that most of that performance and low volatility comes from the alternative program, which you see in the second set of boxes from the top. That portfolio is about 63% of the portfolio. That's the hedge funds, private equity, real asset program combined together. Okay, Stephanie, next slide. Another metric that we consider is the growth of the portfolio and what is it that we're doing to add value in this office. 20 years ago, we started with 1.2 billion. The gifts and transfers that Ed was referring to, this is a result of the capital campaign, and also a program where we allow foundations and affiliates that are part of the university to invest alongside of the endowment. So that's about $800 million of new money coming in over the 20 years. And if we invested passively in our benchmark, we would have earned about $800 million on the 1.2 over the 20 years. The activities of our office, investing with managers and making asset allocation decisions away from the benchmark, has added about 1.5 billion above the benchmark. So think of the total return of the program as being about 2.2 billion over the past 20 years, starting with 1.2. And then you add the $800 million of gifts, and you get to the current value less the spending, which is about 1.7 billion in total. That gets us to last year's market value of about 2.6 billion. This year, incidentally, we're spending about $120 million from the endowment to support the university's faculty and students and programs. There's another roughly $20 million that's coming out of what we call the secondary pool. That's the foundations and affiliates that I mentioned that are supporting their programs on behalf of the university and our affiliated hospitals. So we're pleased that we're having an impact, not just on the university, but the broader University of Rochester stakeholder area. Next slide. Gifts to the university continue to be very strong in terms of support of the endowment. The average of our peers is influenced by two very large gifts, the Bloomberg gift to Hopkins, and also a Carnegie Mellon transfer into their endowment of a settlement, many hundreds of millions of dollars in a intellectual property lawsuit. So, and that's counted as new money coming in as gifts. So the mean of our close peers for the past 5 years has been about 2%, but the mean is really not the most accurate measure because of those two schools. The median is about 1.4, and we're still a little bit below that, but we're in the ballpark. And every year we gain on the gifts against our peer group. Our spending, this is a 5-year average of the annual spending. It's not our 5-year spending policy. It's a little different than the policy. But compared to our peers on an apples to apples basis, we're exactly at the mean and the median of our peers. Okay. Stephanie. Growth is the sum of performance, investment performance, plus the giving and spending. Our endowment grew by about 2/3 over the past decade. The median of our peers was about 71%. That's really influenced by the large gifts I mentioned. The mean is certainly very influenced by that. So I think the median is the more accurate measure here when we look at our close peers. So we're in the ballpark on endowment growth. And what I think is important is the trend, that we continue the trend of improved giving. We continue to maintain an appropriate spending rate that balances today's needs against future generations. And I think we're doing a very good job of that across the university. Next one, Tim. This is just the sum of endowment growth. We've had very steady, endowment spending. We've had very steady spending over the 20 years. I think I am right at my time limit. So at this point, we open it up for some questions. And Stephanie, you're going to moderate those questions. And there were some that were sent in advance. So do you want to cover those, and then we'll cover the live questions?
Yes, absolutely. William submitted a question. Please describe your method of directly sourcing interesting private investment equity and debt deals using alumni networks versus investing through funds.
Yeah, there's a couple of points there that we should describe. The first is we're agnostic as to the sourcing of investment manager ideas. Some of them are submitted by alumni, but generally it's through our own research. We're also agnostic on Rochester area managers. We don't have a geographic preference for firms that are in the Rochester area. There's also another component to this question about direct investing. We don't make direct investments in companies or direct investments in alumni activities. We think it's very important that we have a process that's strictly on the merits. We've used that term a lot, but we don't want there to be any perception of conflict or bias or anything like that. So we want the very best managers we can find across the globe. And the 4 investment officers with me and the team, that's what we do. all the time. We have thousands of firms we know, but we don't have any preferential treatment for alumni or folks in the Rochester area.
Great, thank you. Bob asks, what external investment managers manage the assets, and also who is the custodian bank?
Starting with the last question, the custodian bank is Northern Trust Company, so in Chicago, and we've had that for many years. They will continue as our custodian. We do use an outside administrator to help with reporting and activities on the alternative side. That firm will changing firms actually on July 1st. That's a firm called Strata based in Utah. The firms that are managing the portfolio, we do not disclose. And there's a reason for that. We think we have a good roster here. We don't share it with many outside of our friends in the endowment industry. And that is a way that we also get information from our peers. Some of our managers have confidentiality agreements also, and we don't want to violate those. We have about 60 firms that we use for the bulk of the allocations. They manage, I think it's around 90%. We tend to allocate somewhere between 2 and 3% as sort of a full position. Some firms are smaller and some firms are larger. And that's the benefit of this office is we make those allocation decisions and the weights on the managers. And interestingly, when we look at the performance attribution, we find that the activities of manager weights, and Ed kind of referred to this, is greater than the contribution from the managers outperforming a benchmark. So it does show that there's value added from the activities at the office and with the investment committee. Long answer.
Thank you, Doug.
Thank you for the question.
Ron asks, how are decisions made to change or eliminate an investment vehicle, and how long is performance below expectation acceptable before a change is made?
Yeah, starting with that last part, there is no predefined length of time. A lot of institutions might say 5 years is the right period. If a manager doesn't perform well, you should change. We do a thing called prospective hindsight, where we look at managers' track records and try to determine if the lulls in performance, relative performance, can be attributed to portfolio decisions, or is it just a poor management decision? Because sometimes managers will have very good performance after a 5-year underperformance. And it's often the worst time to terminate a manager. So we look at this with hindsight, what we've learned, and some managers that we've terminated, we've learned they've had great performance after we left. So we're very hesitant to put a time period on it. It's the other part of this is the construction of the portfolio. Some managers are in the program for a specific reason. They may have characteristics, as I mentioned on our emerging markets program, that enhance or dovetail with other parts of the portfolio. So we may not be as concerned if they underperform a benchmark if we've hired them for a mandate that is a little bit away from the benchmark. And some managers in the portfolio are not benchmarked at all. Our hedge fund program, for example, we have longer term views about stable returns and meeting the benchmark, the total benchmark for the portfolio. And of course, our private equity program, we expect that program to outperform all of the public equity benchmarks like the S&P and the equity, and they do.
Great, thank you, Doug. Albert asked a question about the LTIP's hedge fund program, which I believe you already answered in your presentation. But then Andy asked, how many different unrelated hedge funds do we invest in?
Yeah, by the way, I'm not sure we defined what the LTIP is. We keep saying that, and we heard about the endowment. Let me just take a minute to explain that. The LTIP is called the long-term investment pool. And the long-term investment pool has about 84% of it is the endowment of the university. The other 16% is what I was explaining, the affiliates, foundations, and also some trusts that we manage alongside of it. So it's all earning the same performance. It's all part of the same big mutual fund, if you think of it that way. But 84% is the endowment. So the LTIP, when we think about the, so just repeat the question again, I'm sorry.
How many, I believe the question was removed, but how many different hedge fund
Oh, hedge funds.
strategies do
Okay,
we
so sorry,
invest
thank
in?
you.
Yes.
Yeah, so we have over a dozen hedge funds. The hedge funds do not correlate to each other. That's a very important characteristic of our program. They don't correlate to the long-term investment pool risk characteristics. They are a group of very experienced people that manage their own money, and we're alongside of them as partners. Uh, and it's a very high bar for us to get into these hedge funds. We typically don't change that roster very often. In fact, some of them have been around for at least 20 years. But you should never be reading a headline in the Journal or the New York Times or whenever you're reading about a problem with one of our hedge funds. They're very stable, high-performing groups.
Thank you, Doug. Daniel asks, how is the endowment used to support graduate student fellowships, stipends, et cetera?
This is important to clarify. The endowment supports, the main part of the support is for faculty salaries. And our faculty teach undergraduates, they also perform research, but importantly, they also interact to a great extent because we're a research university with our graduate students. So an endowed professor will have multiple responsibilities, including graduate students. So the graduate students may not see it directly, but it is certainly a big part of the endowment is supporting the faculty who in turn teach the graduate population.
Thank you. Robert asks, what dollar amounts are presently in the UR endowment that are not restricted by the donor?
Yeah, the endowment, so looking at that 84%, that's the endowment within the long-term investment pool, roughly half of that amount is money that was received by the university through donors that did not specify either that it goes into the endowment, or if it goes to the endowment, it doesn't have a purpose, or it's just general endowment. What the Board of Trustees do in those cases, they resolve to put that money, this is through a formal vote of the Board of Trustees, into something that supports an area that the deans and the leadership of the university feel needs to have endowed support. So that money becomes permanent endowment, but it is also considered funds that are functioning as endowment. So the board would have to undesignate by a resolution each one of those endowment funds. It's a legally binding activity by the Board of Trustees. So donor designated, think of it, somebody gives to an endowment fund to support a professorship in psychiatry. That will always stay with that professorship in psychiatry. If a similar fund comes in from the Board of Trustees, it will stay with the professorship of psychiatry until the university decides, the board, it's never happened, but if the board decides that they have to undesignate that money, it could be undesignated.
Yes, and a related question from Andy was, are restricted endowment gifts invested differently than the general endowment or employee commitments, pensions, 401 accounts, et cetera?
Yeah, all of the endowment is managed the same way. There's restricted, unrestricted, board designated, it's all managed the same way. And those 2,600 funds that I mentioned are, they receive a monthly return from the pool. Pari passu, it's the same for every single one. All the other things that were mentioned in that question, the pension plans, those are separately managed. Those are mostly affiliate defined benefit plans. There's a separate committee for that. Also the defined contribution plan, I'm a member of that committee, the retirement committee. Those are fiduciaries for the employees and the retirees. And that is a separate, it's part of the university, it's not on our balance sheet, but is a separate but very important function with almost $6 billion of employee money. So we look at costs and low cost options and how the reporting is handled. And I think that we've done a very good job with that.
Thanks, Doug. Neil asks, have we done socially conscious investments? Is the decline in natural resources part of a departure from fossil fuels? Are the trustees involved in advising your team on investments, for example, climate change initiatives?
Yeah, addressing the fossil fuels part first, there is considerable discussion about this on campus and with the investment committee of the board. And I shouldn't go too far on this, but let me just say that it is under serious consideration it's been on the agenda of the investment committee, and I would expect more discussion with that with the committee in the coming months, and maybe a decision coming. A lot of schools have put policies in place on fossil fuels. We have a policy that prohibits us from investing in thermal coal, which is coal that's used for power plants, and tar sands, which is a very inefficient way to extract fossil fuels. There's a committee chaired by Professor Randy Stone called the Ethical Investment Advisory Committee, which works with our office and the Board of Trustees Investment Committee on specific resolutions and concerns that are raised through the campus community. It's been a very effective partnership, and we expect that to continue. The other part of this it really is the larger issue of ESG, so environmental, social, and governance. We do not have ESG restrictions on our investment managers. So what we do instead of that is we follow a practice we call corporate shareholder responsibility. And we want our investment advisors to assure that the portfolio they're constructing for us when they're investing in companies, so those companies comply with environmental policies, regulations, laws, that they're good actors, that they're not causing social harm. We've had that policy. It's actually in the investment policy statement that the investment committee approved. It's on our website if you want to read it. It's been very effective. And the Ethical Investment Advisory Committee chair looks at a document that we prepare every year that shows our efforts on CSR and our responses on our CSR questionnaire. So we want to be very good citizens in the investment community, and this has been an effective policy.
Thank you. Leslie asks, how is the investment department incorporating the university's broader goals of diversity, equity, and inclusion in the work that you do?
Well, Stephanie, you should answer that question. We are very committed to this. In fact, more so than most other universities, I would say. And Stephanie and Rob Rabari, who are on this call, are really taking an enormous leadership role in this. I would say that we're still at the nascent stages, but we'd like to see the investment management community become more representative of society in terms of their employees and their practices. And there's a big effort in endowments and foundations to get this moving ahead. And I should say, I'm proud of this work that we do here. And as with everything that we do in the office, it's a team effort, and different folks lead parts of it, but this is one very visible and new part. So thanks for the question, Stephanie. Thank you, and Rob.
Of course. And if you want, I'd like to add to that, Leslie. In October, we spoke with the investment committee for the first time on these topics, and we presented 3 broad initiatives. The first is to survey the LTIP's existing investment managers on their DEI policies and practices and track their progress over time. The second is to identify, evaluate, and potentially make new investments in firms led by women and underrepresented minorities, and also sharing ideas about these managers with our peers. And the third is to create and support initiatives that improve opportunities for women and minorities in the investment industry pipeline. So thinking about the industry more broadly.
Thank you, Stephanie. Thank you, Leslie, for the question.
Our next question is, when the university runs an operating surplus that's not all invested into the endowment, what's the saving or return mechanism? How can those funds receive interest but stay relatively liquid?
Yeah, this is a little outside of the scope of this call because it gets into university finances, but I'll just touch on it briefly. That the university runs, sometimes we run a positive margin, and it's really up to the finance team and the department and divisions and schools to think about what they do if they have a margin, whether they save it for budget buffering if we have a bad budget, or they use it for capital projects or other things. But really, it's outside the scope of this call, so I think I should just stop there.
Sure, thank you. Thomas asks, the gifts and spending slide shows 4.9% spending. Is that the amount of the total endowment that has been spent on average over the 5-year period? I was on the Faculty Salary Reduction Advisory Committee, and we were told that our endowment spending was bumping up against the board policy of 5.7% spending. and also against the constraints imposed by New York State in 2010?
That's an accurate statement. The constraint of 5.7% is calculated on a rolling 20-quarter average. And what I attempted to say about the 4.9% is that is an average of our actual spending versus a point in time value of the endowment. And the point in time is June 30th of each fiscal year. So whatever the fiscal year spending was divided by the ending market value, that is the metric that all of the other peers are submitting to the survey. It is not the same as taking 20 quarters and then applying 5.7% to it. That yields a higher spend rate. So there's apples and oranges here. The reason I put the 4.9% in there versus the peers is to show the progress we've made through constraining the spending at 5.7% to getting us to the peer average. When I arrived here, our average was around 7%, and Ed will know this quite well. That is an unsustainably high rate. And we've had a very good period of performance. We have to be sure that our spending is not so high that if performance has a down period, that we don't get back to that. Even a 6% rate is not economically sustainable. So I think that we're being prudent with the 5.7%. The other part of that question is New York State guidelines. We do have to adhere to something called MIFA, New York Prudent Management of Institutional Funds Act. And that does specify 8 different tests that charities have to follow in setting their endowment spending rate. And that MIFA came about after the global financial crisis in 2008, 2009, because some charities put themselves in jeopardy by spending too much from their endowment to get through that period. So I think this is through the New York Attorney General's office. We do have to comply with it, and it's considered by the Board of Trustees and the Investment Committee in setting the spending policy. Good question, though.
Thank you, Doug. Ron asks, you have said that internal office and custodian expenses are equal to about 0.2% of the endowment. What are the total expenses, including the outside manager fees?
Yeah, so the 2%, it's about 20 basis points or 0.2% for the office. That's the internal office is about 0.9%, and then consulting custody is about 0.11%. That's how we get to the 20. The outside fees we pay to managers, the base fees that we pay are somewhere around 1%. And we've learned that we have these incentive structures that can incur another 1 to 2% when managers outperform their benchmark, or they achieve certain milestones or triggers on what's called carried interest on its profit participation. So we've learned that when we report those numbers, which the total would be somewhere in the 2 to 3% range per year, we report those on our tax form for many years, and we found that other schools are just including the base fee, what the manager fees are, around 1%. And there was a discussion of this with the Faculty Senate and others last year. We've modified our reporting so that we're consistent with peers. So if you think about the base fee, think of it as around 1%. When managers do well against the benchmarks or against the hurdles on profit participation, if you add that in and consider that a fee, that's another % or 2 per year. Everything that we show to the investment committee in this presentation to our stakeholders, it is all net of fee. Every single fee that we incur is netted out against that performance. So again, if you have managers that are performing well, you would expect them to earn that incentive fee. And it's good that we pay those fees because we're earning more money for the school.
Thank you. Daniel asks, can you discuss how funds raised in the next capital campaigns are added to the endowment? I'm wondering in particular what fundraising means for scholarships and grad student fellowships.
It's a great question, but again, this is outside of the scope of this call. Typically, the last campaign, about a third of the funds were designated for endowment, and you saw that in the slide I showed sources of money coming into the endowment the last 20 years. I would expect going forward, we'd have, if there's another campaign, when there is another campaign, that it would be something like that, somewhere around a third. The other third about a third goes toward capital construction. People like to get their names on buildings at universities. And then about a third of it is for annual operating expenses. So there's an annual fund, and over the life of a campaign, you add those annual funds in to get to the grand total.
Thanks, Doug. There was a question that was asked last year, and I'd like to repeat it. When Advancement describes the state of the endowment to a potential donor, what should they focus on or emphasize?
Well, as I said early in the discussion, I do think that we take an unusually broad view of the stakeholders and stewardship of the endowment. What's not known by many folks on this call is that donors to the endowment get a report every year showing how their money is spent, the rate of return, and they get a very nice glossy book that Leslie puts together, showing the importance of the endowment overall to the university. So I think we're very good stewards of capital, and they should know that there won't be surprises. The University of Rochester's history is particularly intriguing to me. I knew the history here in the 70s and 80s when there were some challenges in the endowment. That is very unlikely to be repeated. I think the board has made it a priority to make sure that we're not surprising the donors and our stakeholders. So I would think about stability, stakeholder, and stewardship as important for donors.
Great, thank you. Looking out 5 years, what is the view of the investment office on the return environment for endowments?
Well, we've certainly been surprised on the positive side from what's happened the past 5 years, even the past 10 years. And I would say over 20 years, we've certainly done better than, 20 years, we've met the expectation of about 8%. And for 1, 3, 5, and 10 years, we've exceeded it by quite a bit. We do model this, model the portfolio every September when we plan for asset allocation with the committee. The modeling has continued to show a nominal return. This is just the gross return after, net return after fees of about 8% per year. That's what's used in the university's financial model. We'll see where we go in September. It's a little too soon to predict. Generally, when asset prices are high across the board, which is what we have today, it's followed by periods of lower return expectations. So maybe there's some downward pressure on return. Our diversification, particularly our hedge fund program, which makes money in all kinds of environments, should help stabilize our return. But for now, 8% is the goal.
And that concludes all of our questions.
By the way, Stephanie, if there are questions that weren't able to be addressed here or questions afterward, we'll be sure to answer those individually. It is almost 12 o'clock. I just want to thank everybody for joining these meetings every year. As Stephanie said at the beginning, we have about 160 participants. That's a good number. I think we had slightly less than that last year. And I hope that you'll continue to support the university through giving to the endowment and can talk to your stakeholders about what we do, and that you'll engage with us. Send us questions, give us a call. We're really happy to answer any concerns or questions. And I want to, again, thank you for that wonderful introduction. It was really kind of you. Well, thank you, everybody, and we'll see you again next year.